What is going on out there, peeps? All right, let's get back into the gold, silver, cryptocurrencies. Yes, some interesting things. We've talked about Basel III, and I'm going to drop a little more info on you that you're going to feel good about in just a second. If you haven't by now, I think your windows is closing really quick. You'll see why here in a moment. You should be buying into gold and silver at this present moment. It is meant to protect you from a crisis and hedge you against inflation. But we're in a very unique time in which people have an opportunity to actually gain some wealth on the price change that's going to happen to precious metals. You're going to hear about that today. So, if you're thinking about buying precious metals, please give a consideration to our friends over at Money Metals Exchange. The link is down below underneath the video in the description. If you are a first-time buyer and you spend more than $100, use promo code Pimpy, P-I-M-P-Y, and get a free half ounce of silver. For those of you asking about my address, there it is. And I want to encourage people to go over to my other platform and check out the videos that are being posted there. Last night, quite a few videos were dropped. Some of them very serious. You need to, if you haven't yet, check out this one right here under this category. Very serious, very serious. It's got a lot of information that I think will definitely catch your attention if you get my drift. Don't forget to send some love over to our friends over there at Wall Street Silver. Both their YouTube channel as well as their Reddit page. Links are down below. Go over and check them out. You guys know I got Pimpy's Investment Chat, same name as the YouTube channel. Over here we do talk about gold, silver, cryptocurrencies, as well as foreign currency investments. So come on over here and join us. It's free to do so. The link is down below. So what is going on here in the markets? Let me go ahead and refresh this because it's changed since then. In case you haven't noticed, there's a little bit of a change going on with gold and silver. Yeah, $10.50 increase, 50-cent increase. These are nice little jumps. There might be a reason for it. Told you at the beginning of July we were dealing with, or since the 28th, we've been dealing with July contracts, July deliveries. They're going to talk about that. Basel III on June 28th took effect over in Europe. Basel III for the United States took effect yesterday, July the 1st. Filling these contracts when they have an opportunity at a much cheaper price appears to almost be done. And now the regular markets are going to start taking over the true values of gold and silver. But wait, there's more. You're going to have an individual named Mr. McGuire explain to you that it's just not a matter of allowing the markets to take over. The price for gold and silver is going to have to be reset, revalued, and he'll explain why. You heard him before. He's the gentleman from over there in the UK. He's really sometimes hard to follow because he is very technical, and you can tell he's a guy who takes a lot of pride in his work. He's something else to listen to. Cryptocurrency, slightly disappointed. I thought you guys would have took off by now. You started to show some signs of it, but then just kind of pootered out. Polkadot still hanging tough at the front of the pack, followed by Hex right behind him, and the Ethereum is about halfway below the halfway mark. We got to look at over there, the 88, just moving around. No, sorry, couldn't resist. Anyways, Dogecoin, oh, good Lord, down 2/3 of where you were before. So will cryptocurrencies move? There's a small part of me that hopes so. And we'll get into that later on. I told you guys I have an interview coming up with not one, but two people that I think you guys would be interested in. We will get more into that later on. But let's get into the world of gold and silver so you could once again feel really extremely happy about your decision making, and you will be prepared for what's coming up. Kenneth says, money over here. I'll leave the link to this video so you can come check the full one out because I'm only going to play part of it. But I want you to hear what Andrew McGuire has to say. It is exciting, but listen to what he has to say. Sometimes it's a little hard to follow, so we'll break it down as we go along.
Gold with Andrew McGuire. Now, Andy, what happens now that the Basel III rules have kicked off on Monday and are kicking off on Thursday in the US?
Well, thanks, Shane. Yeah, good question. And as we know, on Monday, this last Monday, just now, we're recording this on Wednesday. Basel III NSFR standards came into force for most global trading hubs, of course, aside from London, which gets a 6-month extension.
For those who don't know, Basel III first kicked off in Europe on the 28th. Now the United States on the 1st, and London got their 6-month extension, which means January of 2022. It's going in stages.
To comply. Although the US actually follows tomorrow, which is Thursday, but due to the interconnectivity of all of these paper markets, the unallocated over-the-counter and cash-settled COMEX markets, look, the US will essentially be equally compliant on Monday. Now, look, why we have covered Basel III in detail, in fact, really, actually for the last 12 months, we've been focusing on it. In summary, really, what it can be summed up as is really under the new standards, paper gold will be classified as far more risky than physical gold. Hey, hallelujah. And no longer counted as an asset equal to gold, physical gold, or, or coins even for that matter. And this is ultimately bullish for physical gold. And of course, as we've justified before or discussed before, bearish for unallocated gold. Now we'll look at the rationale for this in a moment, but very, very, very short term. People are looking, look at the action, what's happening here? It's Monday, it went down. Yeah, as we warned, while the unwind of unallocated gold accelerates, and look, we're seeing evidence of this, and you can look for yourselves. Look at the related COMEX open interest rate.
Okay, so you're going to listen to Andrew get into what I talked about, because everybody's like, well, wait a minute, Basel III kicked in. Yeah, just in Europe, but all of a sudden the prices were going down. Why, Pimpy? I told you they got some cleaning house to do. They have some cleaning up to do. They have some contracts that they have to fill. They have to move them out of the unallocated, do delivery. They're not going to do it at a higher rate for silver or gold. They had to do their last minute tricks to force the price down so it costs them less to fill the contracts. Wait till you hear how much Andrew explains.
Reductions. I mean, from 800,000 contracts, and that was lots, that was back in early 2020, to just 450,000 contracts yesterday. That's a 350,000 lot open interest. Look, give an idea of scale. Look, these are just numbers, but look, that's about 1,100 tons of paper gold into, this is the important part, into a $300 price rise. And that's even accounting for the current BIS OPEX gaming into today's Mark the Market event. And, we've always warned about BIS OPEX. It's just one of those times where you're going to see about $1 trillion of derivatives mark to market. And, no coincidence that we usually see these kind of smacks. But this could be the last time. Now,
Smacks, what he's talking about is when the price or the value of gold and silvers are knocked down. They're smacked down is what he's talking about. So he said it shouldn't be a surprise based on the way they manipulate it. X amount of paper hit the market, why physical, the pressure to buy physical at a cheaper rate was necessary. That's where he's going with this. But this most likely would be the last time.
Really, so what we're saying is very, very short term. Into this algo-driven mix, this short-term price volatility into such a large cut in overall open interest must be expected, because when you close off a long unallocated gold FX position, it initially requires buying the short dollar leg back to square up this, and that means selling the long to square up this unallocated 100 to 1 gold credit position.
100 to 1. That's how many contracts they sold for every actual 1 physical ounce of gold.
That's all it is, a credit position. But the offset to this heavy foreign exchange gold action is the strong sovereign size spot indexing, which, if you remember, that just simply means locking in the price in the spot market, with real buyers looking, what they're doing is seeking to take physical delivery on a T+2 basis. So you've got one side selling, the other side, real buyers saying, thank you, I'll take it. So each day, as this situation resolves, paper market overhang is evaporating. Now, given the 100 to 1 leverage, in gold and joined at the hip silver, which is 500 to 1 at the
Woo, man, did you hear that? If there's 100 contracts sold for every 1 ounce of gold, he's saying there's 500 contracts for every 1 ounce of silver.
margin. This paper market unwind is increasingly bullish and bodes well for a rally after BIS OPEX today. And of course, we have to wait for the obligatory non-farm payrolls gaming on Friday.
And he was right. He's talking about they did this interview on Wednesday. It's Friday. He said we should see the prices start to go up by Friday, and we are Friday. We're seeing the prices go up.
But very short term, this heavy action into the options expiry, and as we anticipate into non-farm payrolls probably on Friday, really it reflects the balancing of these two forces.
Andrew, here's a question. Are officials going to be subject to the Basel III rules?
Why are you
On
yelling?
the face of it, Shane, yeah. But as we recently outlined in earlier episodes, it's not going to be immediate, but they are seeking to take control of the physical market. Let's not forget what is behind this, which will continue to evidence the BIS closing unallocated contracts and associated swaps. However, the most important point is that all their agent banks, that's all the too big to fail banks, and these are the market makers, the bullion bank market makers who have gold accounts with the Bank of England, they're going to have to be compliant. And the BIS is orchestrating this for them. Now, the governing factor is that competing central banks and sovereigns will actually demand physical gold purchased at the London gold fixes. And they're going to need that to be in the vaults and deliverable before anyone's going to ever place orders. Now, if they don't think that the bullion's there to meet a T+2 delivery obligation, what are they going to do? They're going to actually move. I mean, that's what happens on the SGE. That's what happens on every other physical exchange. What they're going to do, these physical orders will flow out of Loco London into the physical markets and exchanges that are compliant, rendering the current Loco London price setting fix completely obsolete. Clearly, they're not going to allow this to happen. So really what we're saying is after 50 years of containing gold and controlling the paper gold markets, now the BIS needs to get control of the physical gold market. And the only way to do this is to get on the long side of gold before it's revalued. And this process begins now.
Get on the long side. For those of you who wonder what he's talking about he's talking about when you invest money into a particular asset. You can either go short or you can go long. He's saying that they're going to have to go long, meaning they're banking on the fact that gold and silver are going to go up in value.
And it will gain traction into the end of the year.
So, Andrew, with all that being said, how do you see gold being revalued?
Yes, Shane, really good question. Let's deal with the revaluation process, shall we?
Shall we?
I mean, look, historically, it's hard, this is going back a bit, but historically gold has only been revalued twice in the last 100 years. And on both occasions, this increase in assets allowed the Federal Reserve to further inflate money supply. Now, the Fed, look, obviously the Fed doesn't hold any physical gold. We know that. It holds gold certificates. The certificates are issued to the Fed by the US Treasury, who claim to hold these unaudited physical reserves. And this is a smoke and mirrors relationship. Now, we've discussed this before, but by valuing 8,133 tons of gold held by the US at just 11, it's priced at 11 billion. I mean, this is 8,133 tons.
Yeah, but if you remember correctly, they value the gold that they're holding at $42 an ounce.
Because of the price it's valued at, it allows the Fed to have a paper claim on all this gold at $42 an ounce.
Yep.
Now, the first revaluation by the Fed was in 1934, when the gold price was repegged up from $20.67
to 35.
and then it was pegged up to 35 cents, which is effectively increasing the gold on the Federal Reserve's balance sheet by 69%. Now, this increase in assets allowed the Federal Reserve to further inflate the money supply. Hey, Does that sound familiar?
A
I mean,
little.
is history rhyming here? Now, if the Fed,
Did
I
it
mean, this is
say?
just
Did it say is history rhyming or repeating itself?
speculative, but history tends to repeat itself. Now, if the Fed once again sought to mirror this 69% gold revaluation, it's just a question here. That would raise the $42 price to 71 bucks. Now, but based on today's BIS sweet spot, which is actually between 1750 and 1800, technically this would forge the a treasury price of.
Now, let's make sure we don't get anything confused here. The gold that we hold, the U.S. Treasury, given the Federal Reserve gold certificates, the gold was valuated at $42 an ounce. He's saying a revalue would bring it to $71 an ounce. But he continues.
$3,000 an ounce. And that still looks too cheap to accommodate Basel III NSFRs, which will expose gold credit positions to a physically settled marketplace.
So you heard what he's saying. They're going to need to do it at somewhere closer to $3,000 an hour or $3,000 an ounce. But there's a problem. Do you remember what he said? Contracts to physical? 100 to 1. Yeah. So take that 3,000 and multiply it times 100. That would have to be the real value.
Look, any price differential will be arbitraged by a physically starved market at current prices. Now, ultimately, the COMEX will have to become a delivery market. The evaporation of open interest into Basel III is not a coincidence. And we just looked at those. Look at the scale of that unwind. And as we discussed in our last episode, with Basel III about to value physical gold as a real cash equivalent, is it time for the Fed to revalue these gold certificates to market to accommodate literally trillions of dollars of money supply? But at the
Raise your hand if you say yes, it's time. I say it's time. How about you? I think it's way over time. Go ahead and do the revaluing. There is a part of me, though, I'm not going to lie, that says, well, maybe, hold on. Don't do it yet. I want to stack more.
same time, simultaneously protect dollar hegemony. And we talked about dollar hegemony as being one of the primary drivers here. Now, given competing Chinese and Russian central banks race to exchange their overpriced debasing dollars for physical gold, footprints suggest it is the only option, forcing the BIS to buy gold and to allow a revaluation. So very short term, BIS OPEX is likely to cap gold between 750 and 1800, after which, and that's what's happening today, after which we anticipate a steady rise into a minimum of 2300 into year end.
That's minimum on gold, $2,300 an ounce. But wait, he's not done.
Andrew, I think you were one of the first to talk about the Basel III rules, and many, many more people are talking about it. You had mentioned that there are different and many, many different opinions on the effects that Basel III will have on the gold price. Now, just before Jim joins us, can you tell us why Basel NSFR, those standards are bullish for the price of gold and for the price of silver?
Yeah, Shane, let's not forget the whole reason Basel III must be implemented. The objective of this NSFR is to force banks to finance long-term assets with long-term money to avoid liquidity failures really that threatened the banking system following the 2007-2008 global financial crisis. Now, given gold derivatives comprise pretty close to 70 trillion, I'm talking about all derivatives here, swaps, futures, forwards, etc. That's 70 trillion of interbank counterparty risk. There's no going back from this directive. Not if you want to protect dollar hegemony. So while there are a lot of differing opinions on the impact of these standards will have on the gold price, every negative spin that we've seen or heard, and I've read, results from these changes being viewed through the lens of a 50-year cash-settled legacy gold market. It's understandable. Now, namely, gold benchmarked against the COMEX cash-settled futures market, which was born out of necessity 3 years after Nixon closed the gold convertibility window in 1971. So the problem stems from the fact that the LBMA and the World Gold Council and the current legacy pricing system, it doesn't differentiate between unallocated gold from allocated gold. There's where the issue lays. So therefore, when we see published basis and co-basis data, which determines how GOFO is set, that's the difference between LIBOR and the gold lease rate, which is what the algos trade off, it reflects this anomaly, and by adding or reducing undeliverable gold open interest, officials governing the price of gold against the dollar have tricked the legacy market players into benchmarking their trades upon it. And it's also the anchor argument for those who argue that Basel III will be bad for gold. So for the last 50 years, one unallocated gold market has been used to hedge the other. I mean, go figure. This was quite evident in the LBMA's recent begging letter, and there's no other word for it, to the Bank of England, which attempted to argue from a risk weighting perspective that high counterparty risk unallocated gold, which clears a ludicrous 600 tons of gold a day, of unallocated gold a day, paper credit, should under Basel III standards not be segregated from the 1 ounce of cash equivalent tier 1 physical gold that underpins all of this high counterparty risk 100-to-1 unallocated gold position. Now, the problem with the LBMA centric argument is that under NSFR rules, unallocated gold and its associated counterparty risk moves onto the balance sheet of the legacy trading banks, incurring a 85% haircut. So while physical gold, when hedged with currency risk, becomes a cash equivalent tier 1 asset. So there's the equation. But allowing an exemption would be the only way the paper market dilution could continue. But this would defeat the whole rationale for Basel III, namely to eliminate interbank counterparty risk and protect dollar hegemony, which I will continue to say is one of the main reasons. Now, so obviously in all jurisdictions bar London, physical or allocated gold bars and coins have now become segregated from unallocated gold and reclassified from a tier 3 asset, which is the riskiest asset class you can have, to a tier 1 zero weight, really categorizing it alongside cash and currencies as an asset class. So raising funding requirements for unallocated gold means a financial institution would either reduce or exit the bullion business, or, as the Bank of America, I read a couple of days ago, Bank of America put they reckoned that either that or it would sustain activity and put more funding aside. However, that argument makes no sense at all. When you think about it, sustaining current volumes of 600 tons of unallocated gold trade per day over and above that of legitimate one-to-one hedging or of financing transactions, it'll just become way too expensive and way too risky. Why would you? Why would you take that counterparty risk? Especially as the BIS needs to take control of the physical gold market and will be happy for a higher price.
Yes.
Furthermore, so really, as unallocated gold liabilities move onto the balance sheet of trading banks into a significant reduction in liquidity, and we just looked at the sort of liquidity evaporation that is granularly evident, it means that unallocated gold will have to be priced higher to reflect realistic physical price demand, supply-demand fundamentals, and if not, it's going to get arbitraged. Which is, again, the reason why forcing the COMEX to become a delivery market, which it has to become. And obviously, the COMEX not going to go away. It'll just simply morph into what it's supposed to be. So as an example, if we just take an example, rising costs for market participants.
Okay, I won't keep going on and on. Basically, what he's simply saying is this. As Basel III starts to become implemented, started in Europe first, it's now in the United States as of July 1st. At the beginning of January 2022, the London markets have it. Because of the way the Basel III rules go, and the debt is being transferred onto the books, the allocated, unallocated. So they smack down the value of gold and silver to try to cover as much of the contracts as possible. The physical delivery is still on demand, but the contracts are still outstanding. Although they're talking about gold going to about $2,300 by the end of the year, what McGuire is saying here is, no, they have to revalue. They got 100 contracts for every one actual physical ounce, and it's 500 to 1 for silver. There's no way they're going to be able to do this without revaluating. They have painted themselves into a corner, and there's no way out but to change the value of gold and silver and let the market take over. So congratulations to everybody that's been buying into gold and silver. It's going to change your life for the better. All right? So he filmed this on Wednesday, and he made a prediction that you would start to see by Friday the rise in the price of gold and silver. Not too bad, Andy, not too bad. We are seeing a slight increase, but it says it continues to go. Well, we would like for that to happen. That's for dang sure. I don't know about you guys, but I would like to see it continue to go up. But again, there's a small part of me that's going, well, not quite. I still want to continue stacking, but no, eventually you have to get to that point where you're saying, screw it, let's go for it. I'm there now. I don't know about you guys. So let's go ahead and watch the price of gold and silver go up. Again, as time goes on and people start bailing out, when they get to a point that they feel like they want to sell, and don't be surprised if you don't see them jumping into crypto markets and seeing the price of cryptocurrencies go up. Me personally, I'm not selling the precious metals. I don't trust what's going on. I will sell enough to pay off all my debt and have a little extra money left over. But the truth of the matter is I don't dare part with all of my precious metals. Not until we figure out what the hell's going on with this world. Anyways, that's it. Hit the thumbs up button. If you're not a subscriber, please do so, because when you do, it helps out the channel, and I surely do appreciate it. That's it for now. I'm out.